This is Macro Analytics, delivering frank conversations on global macroeconomics and market analysis, outside the mainstream, featuring discussions and debates between Gordon T. Long, publisher and editor of GordonTLong.com, and his guests. The content of this discussion is strictly the opinion of the participants. It is in no way a solicitation for business, nor is it to be considered investment advice of any sort. Always consult a registered investment advisor before making any investment decision. These discussions are extremely hard-hitting and terribly frank, and parental discretion is advised. Now, on to the show.
Good morning. I'm Gord Long with GordonTLong.com. As part of our ongoing series on financial repression, I have Mark Nestmann joining us here this morning. Since 1990, Mark has helped hundreds of clients seeking wealth preservation and international tax planning solution. He is the author of many books and reports dealing with these subjects and is a very popular public speaker. Welcome, Mark.
Gord, nice to be here.
Well, I pretty appreciate you taking the time and joining us. I'm really looking for the best people in the world who truly understand international tax planning, some of the issues associated with FATCA, etc. And I really enjoyed a lot of the articles that you have on your website. Mark, maybe we can begin with you just giving a bit of an overview of your background and your involvements for listeners that may not be familiar with your work. Sure.
I've been in my career started as an investigative journalist back in the 1980s. I worked with a fellow named Mark Ford, who you probably recognize down at, he now is with the Palm Beach Club and very involved in that. But Mark actually got me started in this back in 1983. He hired me as a journalist back then. My career developed. I got a real interest in the international financial side back in the 80s. I was the original editor for the Oxford Club. I was also the original editor for the Sovereign Society. I went on my own in the late 90s. I started Nestmann.com. Nestmann.com is a website, a portal. We have a lot of free information. I'd certainly encourage your visitors to go there. We have a free newsletter called Nestmann's Notes they can sign up for. I'm also president of a licensed trust company on the island of Nevis in the Caribbean called Fortress Trust Limited. And so we're licensed to form and administer and serve as trustee of offshore trusts, offshore LLCs, offshore international business companies, and so on. So between those two items, it keeps me pretty busy.
I understand you have a master's degree in law from Vienna, also in international finance and law.
That's correct. I went back to school about 10 years ago, and I have a Master of Law degree in international tax law from the Vienna University of Economics and Business Administration in Austria. So that was quite an experience living 3 years outside the U.S. A very humbling experience, I must say.
I've been there. I've lived outside the United States, and in fact, I'm personally an immigrant, so I have a different perspective with that kind of background. Mark, we're here to talk about financial repression. What do those words mean to you personally and your involvements?
Well, this is a long-term goal of many governments, and it's historically, it's been around for literally most of the 20th century. Certainly since World War II, it became very, very orchestrated. And I really agree with the definition you have on your website, that it's a collective set of government policies focused on controlling and reducing excessive government debt through negative interest rates, forced inflation, ring-fenced regulation, and effectively transfer purchasing power from private savings to governments and elites, basically. And I think it's a very good summary of what it involves. I would probably rephrase inflation as forced inflation, because one of the aims of financial repression is to forcibly reduce the effective value of private and public debt.
Well, no question. It's also a wealth transfer from savers of purchasing power to the government debt, and those with highly leveraged loans in that regard. But as you said, you pointed out, one of them is using regulations as a key part, and ring-fencing people's options. And one of the many things that's going on is something referred to as FATCA. And you've written two great articles here recently on, one was why FATCA is a train wreck waiting to happen. The other was called Why Another Country Just Caved Into FATCA. Could you expand on those articles and the key messages?
Well, let's talk about what FATCA is. It's the Foreign Account Tax Compliance Act. It was passed overwhelmingly by Congress back in 2010. And the idea was President Obama basically said, we need to shut down offshore tax havens. So we need this FATCA law, and it was enacted overwhelmingly by Congress as part of essentially a military pensions act. Hidden away in that this is the fundraising aspect of that. No one really knew how bad it was going to be. There were a few people like me who warned about it, but really no one paid much attention to it until a couple years ago. What's happening is foreign financial institutions, which are defined very broadly in the Act, under the law are required to are required to identify their U.S. clients and then force their U.S. clients to basically self-identify, and then the information on those U.S. clients is turned over to the IRS. And there's a couple different mechanisms to do that. If the banks don't comply, if the countries don't comply, then 30% of their U.S. source income, and also 30% in some cases of gross sales revenues in the U.S. of things like stocks, bonds, CDs, this sort of thing, are withheld. And so the 30% withholding is a pretty big number. The definition of a foreign financial institution is very broad. It includes banks, broker-dealers, insurance companies, hedge funds, private equity funds, and so on. So basically, again, the only way that the banks can avoid this withholding tax is to act as unpaid IRS informants. And by the way, non-U.S. persons investing in the U.S. are affected as well. The foreign bank, if their foreign bank is in fact compliant, then their investments get whacked 30% as well. So it's not just Americans that care about this and should care about this. It's basically everybody in the world. But because the U.S. has the largest economy in the world, this is, they basically say take it or leave it if you don't like it. I mean, even Vladimir Putin went along with FATCA. You know, it's a serious situation if Vladimir Putin signs a FATCA agreement with the United States. India recently signed a FATCA agreement with the United States. What's hugely ironic about this, Gordon, is that FATCA is supposed to be a reciprocal exchange of information. So, in other words, there's a carrot along with a stick, and the U.S. has promised, we will send you information from the U.S. on your citizens and your residents investing in the U.S. But the dirty little secret of FATCA is that there's no mechanism in U.S. law to actually do this. So the IRS is making promises that it can't possibly keep. And we now have a Republican-dominated Congress that is in no way going to enact implementing legislation allowing the IRS to do this. It's just not going to happen. So this is only a one-way flow of information. And so I wrote this blog posting a few months ago, Why FATCA is a Train Wreck Waiting to Happen, pointing out that there's absolutely no way in the world that this is ever going to occur. Not as long as we have a Republican-dominated Congress. Maybe if there's an overwhelming Democratic victory in 2016, Hillary gets elected and has a Democratic House and a Democratic Senate, then it might happen. But I think the odds of that are very slim.
What about this concept or this thing called PFIC that's going on? I don't think people are very familiar with it.
You know, PFIC is another aspect of financial repression. It's and another aspect of regulatory restrictions of investment choices. PFIC stands for the Passive Foreign Investment Company. And basically, this is an offshore mutual fund. If you have an investment vehicle, a collective investment vehicle registered outside the United States, the IRS will consider this to be a PFIC, a passive foreign investment company. And the way that it's taxed is very, very unfavorable, because what happens unless the offshore mutual fund qualifies as a U.S. mutual fund and goes and essentially registered at the SEC and goes through the whole process of doing that. And there's another couple ways it can qualify as well, releasing it. It would have to basically be it would have to comply with the generally accepted U.S. accounting rules in order to qualify for treatment as a U.S. mutual fund. If it doesn't do that, what happens is you buy a mutual fund, and every year you hold it, you're not taxed on the income currently, but when you sell it, or when you're deemed to sell it, and there's some ways you can be deemed to sell it, then there's an event called, what happens then is you have to file a tax return reporting the income, but not only the income, but there is a throwback interest charge imposed every year that you've held the fund, and your tax is computed at the highest tax rate that was in effect that year, highest marginal tax rate, now 39.6%, even if your individual tax rate is much lower than that. So what happens for people who have had offshore mutual funds for a long time, they wind up losing every in that fund is paid out in taxes and interest penalties. And they get their principal back because the law says that you cannot, the liability is not going to be more than your initial investment, but you will lose 100% of your profit. So this is basically a way to force people into not buying offshore funds, fantastic offshore funds. I mean, you can buy, I really like Singapore real estate investment trusts. You can't buy those. I like Hong Kong real estate investment trust. You can't buy that. I like things like you can invest in UK dormitory funds, and you can't buy that. You can, I mean, there's all sorts of things you cannot buy because you're effectively locked out by these PFIC rules.
So what's going on here is we're ring fencing your abilities to make investment decisions outside of the country. Either it's restrictive in taxation and you're going to be taxed, or it's so predatory that you won't make that decision and you'll keep your money within the country. So is it fair to say these are an unofficial form of capital controls?
I think that's exactly what they are, and I think that's exactly what the intention is to, we want to keep the way I put it, we want to keep the slaves on the plantation, and we want to keep the slaves' money in our banks. And by the way, if you get bailed in, or which we'll talk about a little bit later, then that's just too bad.
Yeah, because with the bail-ins now and money in the bank, if we have problems in the banking, they're going to take our deposit. That's the way we're out of the next kind of the next solution of a wave of a potential financial crisis.
Right.
So what's happening is investors in the United States are being forced to take on higher and higher levels of risk with less and less return, almost minimal return, and can't get outside the country. That is, in my mind, really what financial repression is from a government standpoint. Is that,
no question.
That seems to be what's going on here. Now, we were talking, but just before the show, and we're talking about citizenship taxation, and you were saying there was even a law about taxes on Mars. Is that what you said?
Yeah, there was back when the space program was at its height in the mid '80s, and we were talking about a manned mission to Mars. Just to make sure that no one got left out, Congress passed a law, and I'm not prepared to. I don't remember the name of the law, but I mean I read this quite recently. Congress actually passed a law in 1986. Making it very clear that if you are an American citizen and you're working on Mars or really anywhere else in the entire universe, you will be taxed on your universal income, and you have to file a tax return. Now, if you're working in another galaxy, it might take a while to transmit it at the speed of light, and they might not get it for 30 or 40 years. Whether or not that would impose penalties, I don't know. I'm not sure they thought that far ahead.
Well, it just shows the absurdity of some of this. But it focuses in on something that's unique about Americans, and that is citizenship taxation. Can you explain what that is and why it's different than in almost any other country in the world?
Citizenship-based taxation, the idea is that if you're a citizen of a particular country, then you have an obligation to pay tax to that country no matter where you are legally resident. And that has several different effects. One, it has the effect of discouraging or frustrating freedom of movement outside the United States to another country, arguably violating treaty obligations the U.S. has signed guaranteeing freedom of movement. But the other thing it does that really people don't think about is it erodes the tax base of the other countries. So if you're an American living in Canada, if you're an American living in Switzerland, if you're an American living in any other country, that country is many times obligated to provide, give you relief from double taxation. So it has to, under the treaties outside of the U.S., give essentially some of the money or a credit for some of the taxes that person pays the United States that it otherwise would go to that country. So it is eroding the tax base of other countries, the citizenship-based taxation. The other thing it does is it forces people to actually, if they want out of this trap, I mean, let's say that you're a 50-year-old guy living in a country like Japan, which is certainly not a low-tax country. You're married to a Japanese citizen. you're still paying U.S. taxes. Now there's some tax breaks that someone can take advantage of, like the foreign earned income exclusion and so on. But basically, the only way out of this trap, you would not be able to participate in a Japanese pension plan because that would be the income of that would be taxed by the U.S. You would not be able to buy Japanese mutual funds because that would be taxed under PFIC. So really, your only way out is to give up your U.S. citizenship. And the United States hates that. They've imposed all sorts of regulations. They make it very difficult to get back into the United States. There's a proposal that would called the Expatriate Act, where if you give up your U.S. citizenship, you'll never be allowed to come back in the United States. And that's already being done informally by some consulates. If you're expatriate, you can't get a visa to get back in the United States. So it's a real mess.
Now there's a tax for surrendering your citizenship, is there not right now?
That's correct. There's an exit tax. Back in 2008, Congress enacted an exit tax for those who give up their U.S. citizenship, or for that matter, if you're even a green card holder. If you've been in the United States for 8 out of the last 15 years and you're a green card holder, you'll also pay an exit tax. Now, the exit tax is only on unrealized gains, and there's some exemptions. I mean, if you have a net worth under $2 million, you don't pay the exit tax. And the first $690,000 in unrealized gains, and that's indexed for inflation every year, is not subject to the exit tax. But there's some other unpleasant effects as well that are not related to the exit tax itself. For instance, your IRAs, instantly, if you expatriate and you have a net worth of $2 million or more, you're what's called a covered expatriate. And if you have an IRA, that IRA, even if you're under 65 or under 59 and a half, that IRA will cease to exist, and every dime of untaxed dollars in that IRA is then subject to tax at whatever your marginal tax rate is. There's no 10% early withdrawal penalty, but that's still 39.6% is a pretty heavy burden to pay. The other thing that happens if you have children, family left in the United States, and you make any sorts of estate planning provisions for them, and you're a covered expatriate, they have to pay tax at the highest marginal tax rate on their inheritance, anything above $14,000. So what we advise clients to do, we've helped probably close to 50 people expatriate. If you're going to expatriate, make your estate planning provisions before you leave instead of after you leave, because it could be, proper planning is absolutely essential to avoid problems. What gets me is that people like Edward Savarin, this famous one of the co-founders of Facebook, when he expatriated, he paid about $350 million in exit tax. He's a pretty wealthy guy, but yet Chuck Schumer gets up in the Senate and said this guy's a tax evader. Tell me, do you know any tax evaders who just wrote a $350 million check to the IRS?
I didn't know anybody had ever spent that much on it. That is unbelievable. These are, for a country where we pride ourselves in being free, these sound like incredibly restrictive policies and restrictions that are being put on, and they seem to be accelerating. What observations are you making?
It is accelerating, and it is frightening. I mean, the rate of the acceleration is frightening. I mean, we now have, we started out with, qualitative easing back in, qualitative easing had been used, periodically, but it really started in big time back in 2007, 2008. And this policy, we need to keep interest rates near zero because the economy has to recover. Now we have to keep, but it accelerates. Now we have negative interest rates in some countries. And now we have, just very recently, we've had a number of countries in Europe in particular, and I think also outside Europe as well, where we have forced negative interest rates on deposits. I think one country, I think it's Denmark, now has negative interest rates on mortgages. So they want, the bank will actually pay you money to borrow from it to take out a mortgage. I mean, this is incredible. But there's a problem with this policy from a government perspective if you allow cash. Because cash, if you have cash in your hand, a $100 bill, and you put it in a safe, you can't impose negative interest rates on that. But what you can do is you can restrict cash transactions. And that's exactly what they've been doing in Europe. I think that's going to spread. We've had some talk about actually the abolition of cash. I don't think that's going to happen without a fight. It possibly could happen. But then all the money is going to go into gold and silver because, again, you can't have negative interest rates on gold and silver. So how do you do that? Well, maybe you immobilize gold. Maybe you confiscate it. So there's there's a way to go, but the momentum on this is very unfavorable to anyone who is a saver, anyone who's an investor, because it makes it very difficult for someone to save money without having it, as you say, in very risky investments.
7 years of zero bound interest rates, and it's not working. The next stage, in my opinion, is, and we've had negative real rates, is moving to negative nominal rates, and we already have $5 trillion in sovereign bonds already trading at negative rates. But the fly in the ointment is cash. If cash is still readily available, very quickly, non-banks are going to start keeping their own treasury and paying cash out rather than paying to keep money at banks. And so we have to accelerate a movement to a cashless society. And needless to say, that's a big bonanza for the banks. That is a very profitable proposition.
Well, absolutely. And when you combine that with the bail-ins, in other words, you can't keep cash anymore. So finally you put your money in the bank and now we have a bail-in and you lose it all. So that truly is financial repression of the highest order.
Mark, what kinds of things from a consulting practice and clients, what's the biggest focus right now that you're seeing besides the things we've just talked about? But are there others?
Well, we have a lot of we have a number of different consulting avenues. Something that's very popular right now is for people to get a second citizenship and passport just in case they ever want to give up their U.S. citizenship. Or maybe they already know they want to give up their U.S. citizenship, but they need a second passport first. So we're authorized agents for the Commonwealth of Dominica. We've done over 100 of those. We also work with St. Kitts and Nevis economic citizenship, or citizenship by investment, Antigua and Barbuda, and most recently Malta. All these countries now have citizenship by investment programs. Dominica is the least expensive, probably the most cost effective for a single applicant. The total cost is a little over $100,000. So if you have a significant amount of assets and want to get out, or at least have the opportunity to get out of this system that the U.S. has set up for its citizens, Citizenship Act-based taxation and everything, FATCA, PFIC, and everything else, get a second passport, expatriate, live in a country like Panama that has that does not tax income outside Panama, and has an independent source of income through the canal, I think has a lot going for it. It is a dollarized economy, but they've also made provisions to go back to a sovereign currency if necessary. I think this makes a lot of sense for some people.
With your wealth of experience, are there any key messages you'd like to leave with our listeners?
Well, I think the biggest thing is to the extent that you have money in banks, keep it in very safe, very highly capitalized banks. There's a free service called the Weiss Watchdog service you may have heard about. I would encourage people to sign up for that. You can follow the financial health of up to 10 financial institutions. I would encourage you to go with the safest bank in your state. If you can, sometimes hard if you're out of state to open an account out of state. This is if you're a U.S. resident. If you have enough money, get into some of these private banks outside the U.S. that are very highly capitalized in Switzerland, Liechtenstein, Singapore, some other wealth havens. But that's just the banking system. Those banks are less likely to need a bail-in than money center banks in the U.S. and some other countries. The other thing that people can do is hold cash cautiously. Make sure it doesn't have drug residues, because under U.S. law, cash can be confiscated if it has drug residues. So when you go to the bank, make sure you get a bank wrap, notes, keep your deposit, keep your withdrawal slips so that you can prove where it came from. And then silver and gold, because ultimately this is the ultimate store of value. Yeah, I mean, look, they may go down further. Gold hasn't done very well in the last 5 years. I really don't care, because in my book, this is the one asset that they can't bail in.
Well, not yet anyway, but they never underestimate the creativity of our fathers
Absolutely.
in government, and we see. Mark, we're up against our hard line. Are there how would our listeners learn more about your writings, your work, and the things you're involved with?
Well, I suggest they go to Nestmann.com, and maybe you can flash that up on the screen, how my name is spelled. We have a free newsletter, a weekly newsletter called Nestmann's Notes that I write. We also have a number of premium services. Our most popular one is called the Offshore Inner Circle, and members receive a weekly alert from me. They get a bi-weekly video that I record, kind of like what we're doing right now. There's a monthly interview with an offshore expert. I mean, the most recent alert that I wrote is dealt with a concept called fraudulent conveyance, which is where a future unknown creditor might be able to call back a transfer you made to a trust or other protective structure. And I tell people how to avoid that and how to make sure that they don't get caught basically years later. A creditor comes and says, we want the money in your trust, we want the money in your LLC, we want the money in your insurance policy, or what have you.
Mark, thank you very much for the time. Great conversation. We have to have you back again in the future. Thank you very much for your time.
Gordon, my pleasure. Nice to meet you.
Bye.
This has been Gordon T. Long, editor and publisher of GordonTLong.com. New recordings are posted regularly and can be found at GordonTLong.com. New show notifications are available through RSS feed, iTunes, and other social networking venues at GordonTLong.com.